Unpack the incredible paradox of AppLovin in 2026. We are looking at a company generating massive free cash flow, literally an absolute cash machine, while simultaneously experiencing extreme stock volatility. Their share price has seen some dramatic swings, dropping significantly from its highs despite record-breaking financial performance. So we're going to break down exactly why their growth rate is accelerating, why the market is pricing in so much fear, and what it all means for the stock's future.
Right out of the gate, we have to talk about this staggering 84% adjusted EBITDA margin. I really want you to pause and just think about that number for a second. A level of profitability like this is virtually unseen in the digital advertising industry, and it demands our immediate attention. It proves AppLovin is operating with an efficiency that rivals and honestly in many ways exceeds the biggest tech giants on the planet. But to understand how they actually achieved this, we need to look under the hood.
Here is our roadmap for the explainer. 1. Business model. 2. AI competitive advantage. 3. Valuation covering PE versus PEG. 4. 2026 wins and risks. 5. 2027 forecasts. And 6. Disclaimer. Section 1. How AppLovin makes money. So AppLovin's revenues surged an absolutely incredible 70% in 2025 to $5.48 billion. And this growth is driven almost entirely by their software platform segment, which is built on 3 massive pillars. First up is App Discovery, their performance marketing tool powered by the Axon 2.0 AI engine. Now, this isn't about fluffy brand awareness. It's about connecting advertisers directly to users to maximize actual closed-loop sales and installs. Second is Max, their supply-side mediation platform. They currently command an estimated 60% of the mobile mediation market. They practically own the space. And third is Adjust, their suite of measurement tools. Together, these tools don't just serve impressions, they drive real, measurable performance.
Section 2. The Moats and their AI competitive advantages.
CEO Adam Faroki hit the nail on the head when describing their unique 28-day prediction chain. And honestly, it is genuinely impressive. This AI model predicts everything from ad engagement and download behavior all the way down to a user's propensity to spend and the exact dollar amount they will drop, sequenced over nearly a month. Think about how hard that is. If the AI gets any single step wrong along that path, the company loses money. But because this entire system is built on over a decade of proprietary first-party data, they get it right. It's a massive data moat that competitors cannot easily access or replicate. And all of this builds into an unstoppable AI feedback loop. Step 1, they acquire more advertisers, which gives the Axon 2.0 engine more data density. That leads to step 3, where more data trains the prediction models to become even more accurate, which then delivers higher conversions and ROI for the advertiser. Higher ROI attracts even more advertisers, and the whole cycle just spins faster and faster. This density creates a mathematical advantage that makes their targeting so incredibly efficient, it becomes exceptionally hard for rivals, like Unity's Vector platform, to even keep up.
Section 3. Valuation Masterclass. Breaking down the PE ratio versus the PEG ratio.
Let's start with the standard PE ratio, or price to earnings. AppLovin's PE ratio is sitting right around 44.7x. Now, if you're just evaluating the current share price relative to current per-share earnings in a vacuum, the stock might look a bit expensive. But as experienced investors know, relying solely on PE for a hyper-growth company totally misses the bigger picture of their future expansion. You absolutely cannot confuse the PE ratio with the PEG ratio. The PEG ratio takes that PE multiple and divides it by the company's earnings growth rate. Generally speaking, a PEG ratio under 1.0 indicates a stock is undervalued. Well, AppLovin has a PEG ratio of just 0.5x. Relative to its explosive 65.9% quarter-over-quarter revenue growth, this stock is heavily undervalued. The market is essentially handing you a massive discount on their future earnings power. When we compare AppLovin directly against peers in the exact same industry for August 2026, the picture becomes crystal clear. On an enterprise value to EBITDA basis, AppLovin trades at 23.08x, which is just a very modest premium over its closest direct peer, Unity, sitting at 21.53x. However, the profitability isn't even close. AppLovin boasts a massive 57.4% net margin. They are literally crushing tech giants like Meta, sitting at 30%, and Apple at 27%. You're basically paying a similar multiple to Unity, but you're getting world-class, magnificent 7-level margins in return. Section 4, the 2026 reality check. Let's look at the accomplishments and the problems. On the
positive side, the accomplishments are absolutely phenomenal. They ended 2025 with an unprecedented $3.95 billion in free cash flow. They've established a massive $3.3 billion buyback program, which acts as a nice price floor to retire over 6% of outstanding shares. Plus, in Q2 of 2026, revenue was up an astonishing 52.4% to $1.92 billion. And they aren't just resting on their laurels, they're successfully expanding out of mobile and into streaming television through their rural integration.
However, we have to stay objective and report the risks because they are definitely substantial. The primary dark cloud hanging over them is an active SEC investigation into their data collection practices, specifically around fingerprinting techniques. Secondly, their highly anticipated e-commerce self-serve platform has been officially delayed to the first half of 2026. Furthermore, they are highly reliant on rented land, meaning Apple and Google's platforms where sudden policy changes can really hurt them. Finally, there's a looming technical threat from competitors like CloudX offering SDK-less integrations, which challenges AppLovin's core software installation model.
Section 5. Forecasting 2027 with multiple scenarios.
Analysts have laid out some wild, widely varying paths here. The bull case, targeting $750 to $775, hinges on that SEC probe ending with just a nominal fine, allowing their new e-commerce expansion to scale rapidly and add a projected $1.2 billion in fresh revenue. The base case, sitting around $632 to $650, assumes steady 20% revenue growth driven by their ongoing dominance in mobile gaming. But then there's the bear case, targeting a steep drop to $340 or $350. This scenario fears that severe SEC penalties will structurally restrict their data collection, completely breaking those AI prediction models, right alongside the risks of operating on those rented Apple and Google platforms. To figure out which scenario is actually going to play out, investors are laser-focused on this specific timeline of catalysts. We're looking at Q3 2026 to see if those 84% margins can actually hold up. Then, October 1st, 2026 is critical. That's the launch of a new referral program designed to accelerate large e-commerce advertiser onboarding. Finally, the delayed H1 2026 launch of the e-commerce self-serve tier. That is the major milestone expected to unlock massive advertising demand from small and medium-sized enterprises. Section 6, Final Takeaways and Disclaimer. Ultimately, AppLovin is giving us a classic show-me story. The broader market has aggressively priced in a growth slowdown and major regulatory fallout. Yet the actual financial data, 84% margins, the 70% revenue growth, the incredibly low PEG ratio, shows a company with record profitability and an ever-expanding AI moat. It's essentially a stock with magnificent 7 fundamentals, trading at a deep value discount simply because of execution and regulatory fears. Now, it is absolutely critical for me to state that this explainer is strictly for educational purposes only. This is not investment advice, and you must do your own comprehensive research and consult with a professional before making any financial or investing decisions. Which leaves us with this final, provocative thought to consider. As AppLovin looks to conquer the massive e-commerce advertising space, how do you personally weigh an unstoppable, highly profitable AI growth rate against the very real existential risks of operating on rented digital land while under SEC scrutiny? Is it the ultimate value play of 2026 or just a really complex value trap? Thank you so much for joining me for this explainer, and definitely keep your eyes locked on those upcoming earnings calls.